Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, February 8th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing well, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
I had another volatile week last week. Equity stormed out of the gate and kind of left January in the rearview mirror after a pretty rough month. Although they're not talking about it, of course, there is that old Wall Street idiom where as January goes, so goes the year, and that's been a pretty good indicator of what to expect going forward. So we'll just keep that in mind and hope that that maybe it won't be too much worse than what we had so far in January. But anyway, okay, the major averages carried a 4-day win streak into last week. That was the longest win streak actually since December. We had a series of strong earnings reports last week. We had some decent, better expected numbers from Exxon. Advanced Micro Devices was strong. Amazon was a big hit on Friday. Alphabet brought the bulls back in. United Health Group. So a wide variety of companies had better than expected earnings, which is good. On the flip side, we had if you missed on guidance or your earnings, you were just blown up. You had PayPal, Metaverse, Clorox, and Ford. They were all punished for disappointing results, or at least weaker than expected forward guidance. So if you don't come in ahead of schedule here, they're taking in the behind the shed and shooting you. We also had a nice rise in the crude oil prices again. They were up over $90 a barrel for the first time since 2014. So the commodity trade is still strong. In fact, the CRB index, which is the commodity index, was on a 5-day win streak last week. It was up 3.5%, and it also hit its highest mark since 2014. And it's not just crude oil prices. We're seeing basic material mining stocks, materials, nickel stocks, copper, everything just kind of stepping up a little bit every day. And so that's probably going to keep the CRB index going higher a little bit longer. We also had on Friday, like I said, we had a 13.5% spike in shares of Amazon. They had much better than expected jobs, better than earnings, and we also had a strong jobs report at the end of the week, and that kind of kept the market above water by the close on Friday, and we actually had the Nasdaq turned in its best weekly performance of the new year so far. So pretty much everything was up a little bit. The Dow was up 1%, S&P about 1.5%, Nasdaq 2.5%, and even the small cap Russell 2000 kind of dusted itself off and was up 1.7%. Now, right now, the technical condition of the market is kind of mixed. Where the major averages are bouncing up to resistance levels and they're coming down to support levels, kind of bouncing in between. The different indicators have improved a little bit, especially for the Dow and Nasdaq. But for the most part, the indicators are they're stuck in neutral ground. Now, we were coming off an extreme oversold condition in January. That's the market's worked its way off of that, which is good. The stochastics were down, single digits here about a week and a half, 2 weeks ago. We also had the 14-day RSI was down in the 20s, which I've mentioned before in here. If you're a technician, not only does the 14-day RSI, not only is it an overbought and oversold indicator, but a good way to look at that is if the market's rising, if when you have these pullbacks, the 14-day RSI can kind of find support around 40. That means that your bullish trend is still intact. If it goes below 40, say 35 to 40, then normally you're probably going to have several weeks of a weaker market in here. And that's what we seem to be doing here, is it's going down into 20s and high teens. So despite some of these big bounces that we're getting, I don't expect the market to really go too much higher. We're seeing the rotation going on still with, energy still remains strong. I think it's up, I was trying to see, I think it was up somewhere around 25% year to date, or actually higher than that, but 24% year to date for the XLE. That's the energy ETF. And we're also, financials are moving up as rates rise. Rising rates are always going to be good for the banks. We'll talk a little bit about that. And also, some of the more defensive sectors like utilities, consumer staples, you're seeing some buying in that. Normally you're not going to see big moves in those sectors when rates are rising, but because of defensiveness of the market here, as the rates are going up currently, as we're just starting that process, you are seeing some people saying, well, I don't want to be in the growth stocks, so I'm going to take some of these that are a little safer for me. As far as the internal breadth goes, we still see some negative divergence in that. The last time the NYSE made a new high, the NYSE Advanced Decline Line was back, I think in early November. NASDAQ also has just been kind of fading off for the last couple of months. Also, we still continue to have more new 52-week lows and new highs. And for the NASDAQ, we've had 11 or 12 weeks where we've put in more new lows and new highs. That's not the sign of a market that's getting ready to bust out here to new highs. So, with the strong jobs report on Friday, with the main thing that we got out of that was that we saw about a 7% rise in wages. And as we've talked before, wage gains are not transitory. They're going to stick. You don't get somebody a job offer it's $50,000, then cut it back to $40,000 because inflation's going back down. So that'll stick a little bit, but we have the FOMC meeting coming up here in about a month's time. I said in the daily last night. That's about a month away, and right now we're kind of getting some different numbers showing up as far as what people are expecting. I wrote in last Friday's letter that as of that jobs report that came out last week, we jumped up to a possible 36.6% chance that the Federal Reserve might hike rates 50 cents in March. I'm still not so sure we're going to do that. It has pulled back a little bit. I think as of today, right now, there's about a 28% chance of a 50-cent rate hike, 100% of a quarter, and then in May we have about a 31% chance of another 50-cent rate hike. And as we've talked before, a lot of the problems with the market certainly can handle a quarter point here, a quarter point there, but it's kind of the ascent, the rapidness of the ascent of the rate hikes that rattle the market. So if we would get a 50-center in March, it's probably going to rattle the market a little bit because we still see some more selling in that. If they did another 50-cent one in May, you'd probably see the market go down 15% or so. So I don't think you're going to see that. I'm also in the camp that I think towards the middle of the year we start to see the inflationary data start to pull back a little bit. That's just me. I don't take my word for it. I would look, see what's going on here. According to Goldman Sachs, I wrote in last Friday's letter, their chief U.S. equity strategist, David Costin, he talked a little bit about the S&P 500 usually has a shock when they get ready to start the rate hike process. And you have to remember, we're still about a month away before they hike rates. So I think you're going to have some choppy trading over the next 3 or 4 weeks. But he did note that after you start the first rate hike cycle, over the next 6 months, the S&P 500 has historically returned about 5%. Again, if we come on here with a quarter point in March, quarter point in May, I don't think you're going to see much reaction to the market. In fact, I think you might even have a little bit of a bump higher if they kind of stick to the quarter point. A half point would probably cause some trouble. So we're at this stage. I mentioned last night that I kind of think that you may see the market go into a trading range here. As far as the S&P 500, the high from about a week ago was 4570. I think that's the 100-day moving average. I would say I think you're probably going with the Dow, the S&P 500, probably, come maybe take out that, go to that high in the S&P 500. That would be around 4580, 4585 maybe. And then on the downside, anywhere from about 4400 to where we are right now. And I think there's a good chance that we just kind of float in between there with some choppy trading until we get a little bit closer to that FOMC meeting where traders are going to kind of have a better handle on what to expect from the committee. And that kind of makes sense. I mean, if you certainly don't want to be short the market, and all of a sudden they just raise a quarter point and say things are kind of settling down, then also the market takes off. And you don't want to be long if they come in and they take a half a point rate hike and then say we see a definite need to raise it again in May. That could cause the market to go down. So with that in mind, I think you just kind of let this play out a little bit, and if you want to trade something, you look at last week's high and maybe you short the market for a quick trade on that, and if you see it come down here around on the S&P 500 around 4,400, a little bit below that, maybe you can buy that for a quick trade from there. So that's what we're looking at right now.
All right, so it's pretty much a given that rates are on the rise, and we've seen the shift from growth in tech stocks into cyclical areas. Do you think this will be ongoing for a while, or should investors be looking to buy the dips in growth in tech?
There's a couple different answers to that. Well, how about going to the ETF Center? Okay. So what I'm looking at here, go ahead and click on the 4-week percent change. Okay, and make sure you start out with the ones from the high, the ones that have improved the most recently. So that would put commodity up there. When you have this shift we're seeing right now, as you can see up here, we're talking about the CRB index making a new high. And as you look over here over the last 4 weeks, you got the energy commodity, with oil going up. That's kind of a gimme. It's up over the last month, 7.6%. The blend commodities are up about 5% over the last month. Shorter in this sector, energy and commodity, the base metals, they've been doing well. They're only up about 3.5%. And you go on down, you have commodity agriculture. Okay, the prices are going up for food. But again, that's only up over the last month, about 0.5%. Then you go on down to precious metals, to see them going up a little bit too. So now we'll go ahead and click on the 1-week percent change. And again, what do you see in the ETS that's leading the market here? Again, you got commodity, precious metals, and again, I think that's more because of the tensions in Russia and China than anything else. But again, you have agriculture, you have the base metals commodity, and one interesting thing here that I see is that you have the blend small cap and you have the growth small cap outperforming here a little bit. And I wanted to just mention on that. Normally, in a when you have a rising rates, small caps don't usually outperform. However, if you go back, I hate to jump around here, but go ahead and go to the charts for a minute and put in the Russell 2000. Okay. with small caps, the reason they don't usually do great on a rising rate environment is because obviously they're looking for growth, and it costs more in interest for them to borrow money, so they borrow less and they don't try to grow their business as strong. So that's the reason you don't see that. However, as you can see on this chart, this big dip. Go ahead and put on the Fibonacci thing. Let's go ahead and take it from the top there, back there in November, down to the low here. Okay, there you can see. Now this bounce, and we have a bounce today, but last week we got up to around 2012, somewhere right around there. Now you're probably going to see, a 50% retracement of that whole move would take the thing back up into that old trading range, somewhere up there around 2120, 2125, somewhere around that. But besides this, go ahead and click on the chart and then do a trend line that goes down from that November high and goes down through the high there at the beginning of the year. Okay, there you go. Now, as you can see where that comes line, one thing about when you draw trend lines and do Fibonacci things, you look for areas where maybe some of the lines are coming together at the same time. As you can see, that trend line, kind of downward sloping trend line from the November highs through the beginning of the year highs and on down. It kind of right now it crosses at the 50% retracement. So that's probably going to be a spot where the small caps, they can get a run up to that. That one, I think if I saw the small caps go up to that level, I would probably start peeling off any small cap things. But they're so oversold at this stage. If you look at the indicators at the bottom there, the 14-day RSI got down in the 20s. We're up to about 45 right now. The stochastics back, in January got down. Actually, they got down to about single digits. I mean, it's down to 5. So you're probably not going to see that anytime soon. But I do think you do have a bounce here, an oversold bounce in the small caps. So I think you can have a little bit of a play in there. And also remember that even if they do stick with the quarter point rate hikes in March and May, okay, now you're talking there would be half to 3/4 on the prime rate. That's not a big that's still cheap to borrow, so that's not going to wreck them. But if you do start to see a half point, and then they start talking that we got to raise it again in May pretty quickly, that would probably hurt the small caps in here. Now the other thing I wanted to mention, we talked a little bit about on that ETF Center, how you can see where all the commodities are still the best performing groups in going out for 1 week and also 4 weeks. Now if you look at the chart again, let's stay on the charts over there. And if you go, looking at the industry group, which we won't go to now, you can see some of the base metals and that type of thing that you can pull up what stocks are performing good. But if you look at here, let's put in, like, say, VALE. So there's a couple of them here that I like. I have to say ahead of time I've owned this. You can see this thing is a little bit of a rounding bottom. We're starting to see these stocks break above, some key resistance level. Now VALE, they do a lot of iron ore. Iron ore prices are way up. They just broke through the 200-day moving average last week, and we see down a little bit lower. You see the 50-day moving average is starting to is turning up. It's going to have a golden cross here pretty soon. I think a stock like this Vale easily goes back to where we were last summer. Part of this, they're the second biggest producer of nickel, which is used in a lot of the batteries, a lot of electric car type of. That's a play on that a little bit also. But you have these things that are breaking out. They were way oversold, but I think Vale probably gets a chance to run back up, to 20 or so you can pick up $3-4 on that. Another play in that same area is BHP, Boy Harry Paul. as you can see, this did have a pullback, and now it's busted, pulled back down to 200-day moving average. Found nice support there, and now we're jumping up again. It's down a little bit today. It opened up higher, but you can see these things. Vale actually had a reverse head and shoulders, which you could pinpoint somewhere around 19 after 20. But BHP is another one that has a lot of nickel, has iron ore, a lot of different minerals. They have also copper. They have, they're a well-diversified company. If you're a little bit older like me, you can look at some of these companies and you're going to get a heck of a dividend off of them also. Vale is going to go ex-dividend, I think around the first week of March, and you're going to have probably somewhere around a 12% or maybe even a little bit higher than that dividend coming out. They pay semi-annually. BHP is another one that pays semi-annually. They're saying it's going to be around 8 or 9%, could be a little bit higher than that. If you do like the gold stocks, maybe more so than the gold miners, you might take a look at NEM, Nancy Edward Mary. And if you think that the gold has a little ways to go, I think this would be a good way to play it, because not only does Newmont Mining have the gold and silver, they also mine. They're a little bit more diversified. They also have copper and zinc. So it's not just a pure play where if all of a sudden everything goes great and Russia pulls all their troops out and China says we're never going to touch Taiwan, then all of a sudden you have gold sink down in you're not going to get hurt on that one if you want to play gold by having Newmont. Another one that you could look at would be TECK, like tech. This one, again, these are making new highs or close to at least, moving up in here. Again, this is another diversified thing. It's got coal, it's got copper, zinc. Last week, I think it was, the week before, coal was one of the top industry groups again. So you're seeing some leverage in that. Another one that I like that we have a long on MarketEdge is Southern Copper, SCCO. This has had a nice run. It went from 57 up to about 69, and it's pulled back now. You're seeing the copper prices. It pulled back from a high of around 69 and change, came all the way back down, found support at its 50-day moving average, and now it looks like it could break out again. So these are some of the companies that I think, with demand on, as we're trying to grow the economy more, you can start having more infrastructure plays, that type of thing. These are a way that the institutions have been buying these for the last month, as you can see. When you go into the ETF Center and the industry group analysis, you can see that the money's been flowing into that. As far as buying the growth stocks on pullbacks, I certainly think that some of these you can. I mean, you look at NVIDIA, it's in a bear market. It's down 25% from, I believe it's November high, whatever it was. You take a look at some of these stocks to see where their support is. NVIDIA came down from 330, came down to that intraday, almost 210, but it closed that day right at its 200-day moving average. NVIDIA is, it's bounced off of that. Now it pulled back last week a little bit, and we're starting to find some, buying in that again. But for these growth stocks, you do want to make sure that you're talking about making earnings, because in a rising rate environment, if you're not making money, you can't project, how you can't predict in the future how your business is going to be like you can when the rates are basically at zero. If people want to have money going in, Microsoft has a great looking chart. It's hardly pull it back. Apple looks great. NVIDIA looks great. But some of these things, when you see them come down on a bad day and they kind of flirt with a key moving average support level, maybe go ahead and you buy a little bit. As far as our cycles go on MarketEdge, it looks like we may have a little bit more of a pullback here over the next 2-3 weeks, and then I think we have a reset and we can start getting a little bit a slow build into the summer again. But it's nothing big, but I think that you're getting on the next pullback, you can buy some of these stocks. Now also, what we're looking at, you're starting to see a lot more in the financial area. That's a place where I think you want to concentrate on going. Last week, the financials were up about 0.5% on the ETFs. That's one of the strongest, categories. And on the industry group, let's see, on the 1 week, metals, non-ferrous, over 1 week in the industry group, they were up 1.8%. Diversified mining was up 1.5%. So you can already, and precious metals were up 3%. So you're already seeing these things move. Now, we had the Internet Financial. We talked about Schwab several weeks ago, that they were one of the benefactors. They don't have all the different offices around the country. Schwab went from, we talked about that. It was around 84, something like that. Now we're up around 94, 95. That, TD Ameritrade. And I think Morgan Stanley is another one that you want to buy because they own E-Trade too. So, they're more diversified than they used to be. And Morgan Stanley will be one that, I think that might have made a new high yesterday or the day before. But so those are some of the financial stocks that I think, and even the regional banks look good as we start to see, loan growth pick up. So there's lots of areas in here that you can look at. Tech obviously is the future, and at this stage, over the next month or so, just have the ones that you like, and you don't want to chase anything, because at these bottoms, you're going to get some of these days where all of a sudden the market gets some good news or something, and it goes up 400 or 500 points, like we saw here a week or so ago, and then all of a sudden it just kind of floats, and then you all of a sudden you're down 500 or 600 points or more, and that's kind of one of the ways you put it at a bottom. But we haven't seen an exhaustive selling pressure yet, so I still think we've got a little bit of choppy trading to go. But there certainly are some places here that you can park your money that I think you're going to be rewarded with some 10, 12, 15% returns over the near term. And, you don't just have to go to all cash. I wouldn't do that because the economy still is in good shape, and, jobs are still coming in, and they're still in an inflationary environment. That means that there's more demand than supply. So I wouldn't freak out. I do think we're going to have, a little bit choppy trading in the next couple of weeks. Maybe we stay in a trading range, and then I think we can start to work our way, inch our way a little bit higher as we get a better grip on what the committee is going to do at the March and May meetings.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.